Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. New highs for the year were set by the Nasdaq. Ross takes a look at crude, gold, the U.S. and Canadian dollars. Author of The Money Bubble, John Rubino, gives us his take on whether the U.S. is heading for recession, office vacancy rates, the shortage of physical silver, and the changing face of cable news. The writer of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, comments on the state of Canadian real estate, HELOCs, inflation, and what kind of price drop would be needed to make homes more affordable. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, how did the stock markets end up the week?
Well, this is one of those weeks we can say new high closes for the year on a lot of indices. The Nasdaq, not surprisingly, still leading the way, but now you got the S&P also joining the parade, and that's the capitalization weighted one, so the Microsofts and major stocks within that index are just pulling it away. Interestingly enough, when you look at the equal weighted index of the S&P, it is lower right now than it was a couple of months ago, whereas the S&P capitalization weighted is higher. So got to be careful with this when the underlying items, the juniors like that within the big complex are having trouble. That support level that we just bounced off of midweek this week should be looked at very carefully. We're getting into the sell in May time window here, where you want to make sure that you've got your stops underneath. It's a good time to be taking some profits if you've got a few stocks that haven't been doing too well and have bounced nicely. This is that time to maybe pare back on them and be ready to buy some stronger stocks during the correction in the second half of the year.
What's happening on the fossil fuel front?
Well, we had that nice big rally from 65 up, and then two waves of correction down. So we've now corrected half of the gain that we had off the low, and nice oversold readings the middle of this past week. So looks as though crude is in the process of preparing for the next leg up. That $82 level that we managed to push up against for basically from December right through 10 days ago. That's going to be a bit of difficulty trying to get through there, but if it does, there's some pretty clear sailing above there. If we take a look and within the energy complex, the other one that is of note is natural gas, which has just been hammered here in this last year, gone from $10 down to $2. Got a big double bottom in here over the last 6 or 7 weeks, and it just looks as though it's trying to turn the corner. Seasonally, typically you will find in bear markets in natural gas that you get a turn in April and an initial high into May. So it's a tradable item. We've been talking about that for the last week or two. So it's managed to go from $2 back up to the 2.5 level. So there's some life in that one, but I wouldn't treat it as an investment position. Clearly, it's just a trade, and don't overstay the welcome.
Exxon made a record first quarter profit, but that's not the same story for all the other oil companies?
No, at a new all-time quarterly high as far as Exxon is concerned. I mean, this is the biggest one out there. But if you take a look at Chevron or Occidental or the Canadians, it's just been sort of a mediocre period in the last few months. Biding their times, nothing big on the upside. It's just a couple of the big names. But a few of them, like Imperial Oil, managed to, here in Canada, increase their dividends. So it's not bad for the shareholders who are in the buy and hold position.
What's happening with the U.S. and Canadian dollars?
Okay, so U.S. dollar is just sitting here doing virtually nothing. I mean, we've been stuck at between let's say par 50 and 102 for a couple of weeks. Trying to base out here, but there's really no sign of any strength as of yet. And we take a look at the euro. There's no guidance in there. Maybe looking a little bit toppy on the euro, but not breaking down as of yet. And over on the Canadian dollar, that is clearly the commodity currency as the oil sold off from 82 down. In the last 10 days or so, the Canadian dollar went from 75 down to 73.25, and by the end of this week, it's bounced pretty much just like the oil market did. So Canadian dollar, just think of it as range bound. 73 is the floor, 75 is the lid, and it's if you're a futures trader, there's a few dollars to be made trading it back and forth. Otherwise, it's just a non-event out there.
What's going on with gold and silver?
Okay, so precious metals, gold is having, it's pushing up against resistance this last couple of months. It's been up to 20.5, but can't get through there. Excellent support at 1970, and these are on the spot prices. If we take a look at this type of consolidation, trying to get through this 2000 or 2050 level, it's like, if we go back in history when it tried to get through 1,000, and then even back into the 70s when it was getting through $200, or in the early 70s getting through 68. Each one of these lids, in terms of price, took quite a bit of time to be eaten through by the bulls in terms of the marketplace there. So at this point, stuck inside the range. I think that if you see the spot price break below the 1970, you're probably then looking at something under 1900 before it's ready to challenge the upper side. And you take a look at the miners. There's really no guidance there to say that there's any strength at this point. So, maybe easing back would be the natural thing to see here.
Ross, thank you so much for the update.
You're more than welcome, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at ChartsByRoss. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. You can find him on Substack at Rubino.Substack.com. Welcome back to This Week in Money.
Hey, Jim.
Is U.S. real estate headed for another bust?
It might. There's a lot of things happening right now that look really bad for real estate. One is that on the commercial real estate side, a lot of buildings went up in the past 10 years using extremely cheap financing. And now, two things have happened. One is that interest rates have gone way up, so that any debt that has to be rolled over on, say, an office building or an apartment complex has to be rolled over at a much higher rate, which might make that project unprofitable. The second thing is that during the pandemic, with all the work at home stuff that went on, a lot of people found out they like doing that better, and they don't want to come back to the office, and office vacancy rates, as a result, are, in some cities, debilitatingly high. It's like 30% in San Francisco, and it's something like 18% nationwide. Those are too high numbers for most buildings to be profitable. So there are a lot of chunks of commercial real estate that are going to be sold for massive losses in the next few years, which is going to either impact the banks that lent the money or the investors that put the money in, whatever. It's going to be bad for a lot of people. Meanwhile, housing in the U.S., pending home sales just fell for the first time since November, and home sales in general are really low. There was an interview on Wealthion the other day, Adam Taggart's site, where a real estate expert characterized the U.S. housing market as frozen. And the reason for that is that prices are starting to fall a little bit, which is inhibiting people who might sell because they remember the highest prices and they don't want to sell at anything less. Meanwhile, buyers can't take out a mortgage because rates are so high, so they can't buy. So we're at a place where not much is going to happen until the market breaks. Usually house prices have to go way down or interest rates have to go way down. And in this case, it's going to be house prices. So, yeah, real estate across the board in the U.S. is a problem. And, these are big sectors. This is a big deal for the economy. So expect a slowdown partially driven by trouble in real estate.
The European Central Bank is set to raise rates again in early May. Rates are already way up. Is this a good time to short European stocks?
I hadn't been paying attention to what the ECB is doing. I knew they were tightening, but they raised their version of the Fed funds rate from negative 5% to 3% in less than a year. That's a really aggressive tightening. Interest rates for a lot of the weakest European countries are way up. In Italy, for instance, their 10-year Treasury bond yield is like 4.3%. They can't handle that kind of an interest rate because they have so much debt to roll over, and they're already so highly leveraged that they cannot accept the increasing interest costs that would flow from rolling all their debt over at these new high rates. So you're looking at national bankruptcies in Europe, and with much higher interest rates, and then the Fed is scheduled to raise rates again in May. So yeah, I would say that European stocks are a pretty good short at this point, just because so much of this stuff is going to come as an unpleasant surprise to so many people who aren't really paying attention. And when it happens, 20 or 30% drop in equity prices in Europe is easy to envision.
Can the so-called PIGS countries, that stands for Portugal, Italy, Greece, Spain, survive with 10-year yields above 3%?
Well, survive in their current form? No, not as members of the Eurozone. That's the problem. See, they're in a currency union with Germany, and the euro is relatively strong compared to what, say, the peseta or the lira would have been if those countries, Italy and Spain, had still had those currencies. So it used to be that when a weaker European country got into financial trouble, they would just devalue their currency. Well, they can't do that with the euro. So they've gotten as far as they have because the European Central Bank was willing to buy Italian, Spanish, and Greek debt at extremely low yields. And now the ECB is not willing to do that anymore, which means those countries have to pay the rates that are commensurate with their riskiness. And it's unlikely that they can do it, which means they're going to be faced with national bankruptcy or leaving the Eurozone. in the next couple of years. And I think that more than likely you'll see an exodus of 5 or 6 really weak Eurozone countries. And maybe the euro will coalesce around the remaining strong countries. So it'll be a very different currency with, let's say, 9 countries instead of 17 countries or whatever. But that's the kind of turmoil that's out there waiting to happen.
The Fed meets the same week as the European Central Bank. What happens if they both tighten at the same time?
Well, if they tighten and they don't promise that was the end of their tightening, then it could be perceived to be an unpleasant surprise for the markets, and we could get some financial issues here in the U.S. from that. We could easily see an equity bear market going forward. And I think that's, the Fed is in a dilemma where it kind of thinks it has to tighten, but if it tightens much more, it breaks the whole global financial system. So it doesn't really know what to do. And I think the fact that they don't know what to do means they're going to blunder into something. And that's my prediction. We'll blunder into something serious.
Silver swung to a massive deficit in 2022. Is that the same thing as a shortage, and does it mean higher prices?
Well, it's a really interesting story in silver because apparently the world demanded 100 and some million more ounces than the mines that are producing silver produced last year. And that, prices didn't go up that much for 2 reasons. One is because there's always manipulation in the paper market for silver, and they just chose to manipulate silver down in the last year. But also there was some above ground available inventory of silver. But the market ran through all the above ground inventory, and the paper markets are pretty high leverage now after all the games they played in 2022. So it's not clear that another year of big deficit in silver could be manipulated away, and it could force prices up dramatically. So we'll see. Which is to say that a deficit might turn into a shortage, which would impact prices and cause some panic buying, and we might finally see that $40, $50 US an ounce silver that has happened a couple of times in the past. And with gold not too far from its all-time high, we could easily see silver go to its all-time high with supplies being this tight.
Oil jumped after OPEC production cuts, but now is back down. Why?
Well, it could be that all these signs of a slowing economy are impacting both demand for oil and the perception of future demand for oil. So let the economy weaken from here, which I think it kind of is guaranteed to do just about. And that's liable to impact the oil market. At the same time, I think the perception is that we're not going to completely electric cars, 100% electric anytime soon, and that there will still be quite a strong demand for oil going forward. So I think that oil company stocks are probably a pretty good bet right now, even with the economy slowing down, just because it's not that easy to produce oil going forward because a lot of the easy deposits have been found, and the new deposits that are being exploited are a lot harder to get to and just structurally more expensive. So I think the long-term structural story for oil is pretty good. And in the short run, there's a risk of a price drop because of the economy slowing down. But I think should that happen, that would be a nice entry point for somebody who doesn't already own a lot of oil stocks. Because most of them pay their dividends, so it pays you to wait until prices go back up. So I think I still like oil stocks, even though it's heading into a recession.
Yes, Exxon had record profits for its first quarter this year. Other oil companies reporting large profits as well. And again, there doesn't seem to be much of a transition plan if they want to get everybody into electric vehicles to go from oil to electricity. Seemingly, they want it done overnight. It took us 100 years to get away from horses.
Well, yeah, and there's right now there's not enough copper, lithium, cobalt, nickel, and other things to do that. We've got to get new supplies of those things, and that means higher prices and new mines, which take 8 years from discovery to actual production through Rubino line. It's not easy. So it's very unclear if we're going to be able to meet the, say, 2030 targets of a lot of countries where 50% of cars are going to be electric by this date, you know, and I don't think that happens. But I think because governments are so serious about making it happen that we'll try. And that means probably higher prices for copper, for sure. I really like copper, too, in this kind of a world, because some of the studies that have come out show a quadrupling of demand for copper in, for instance, the auto sector. If we're going to go from internal combustion engines to electric motors, it's going to take 4 times as much copper as we now use in autos. So we use quite a bit of copper in autos. So that's the kind of thing that can't just be done with a flick of a switch. You've got to find new deposits and bring them online. So if you're a copper miner and you've already got a lot of copper in the ground, suddenly you become a lot more valuable. So I think, again, you know, there's the cyclicality question, and there might be a valley before the next peak. But I think the best copper miners are also very interesting in a world where we're trying so hard to do things that require an awful lot more copper.
Yeah, a study I saw, an electric vehicle uses 277% more copper than a regular car, 83 kilograms or 183 pounds worth.
Yeah.
That's a bit of copper.
Yes, and we're already using most of the copper that's produced by copper mines. So it's not like there's a gigantic stockpile of free copper just sitting around that we can take to, you know, to throw at these new uses that require so much more copper. So it has to come from somewhere. Copper mines, a lot of the copper mines right now are actually seeing declining production. So it's also not like normal growth in the copper market is going to adequately cover the new demand, because we're actually seeing negative growth in a lot of cases. So I think there's kind of a, you know, how we talk about in silver, a deficit might turn into a shortage. We see the same thing in copper, where all of a sudden we're using more copper than we're mining. We're running out of whatever stocks we had above ground, and prices are going to have to bring things back into balance. So that it's very bullish for the best copper miners, and not so bullish for the automakers, because they're going to see their costs go up.
Is Tucker Carlson leaving Fox the death knell for mainstream cable news?
It might be, because for a lot of people, for a painful number of people from Fox's standpoint, Tucker Carlson was the only reason anybody watched that network. Just give you an example of the numbers here. Tucker Carlson used to have an audience of about 3 million people for his show, which was pretty good. That was way bigger than anybody else in mainstream news. But after he got fired, he did a podcast, just a 30-minute thing in an office where the lighting wasn't great. The sound was okay, but, it wasn't TV quality. But so far he's gotten 57 million views, which means that when he sets up his own show, as he has incredible opportunities to do, pretty much any other platform will take him in a heartbeat, or he can just go out on his own. He's going to be bigger than Joe Rogan. And Joe Rogan dwarfs CNN, for instance. So Tucker Carlson will pull a huge audience away from the mainstream media, causing them to shrink even further. So that they're in kind of a death spiral as it is, where they can't pay the salaries of their big people. Nobody really wants to watch them anymore. So they're having to fire a lot of kind of big name talent, which means their shows are smaller and less well done, and so on. Until there's just it used to be that podcats and things like that were kind of the stub that was attached to the big giant mainstream media complex. Well, it's reversing now, where these mainstream cable shows are going to be the little guys who are tacked on to the monoliths that are Joe Rogan and Tucker Carlson and Breaking Points and Matt Taibbi and Glenn Greenwald and all of these guys who are much, much bigger than anybody on cable news. I think the Tucker Carlson thing is a very big inflection point here. So it's going to be fun to watch what he does in the next year. But whatever it is, it's going to be much bigger than what anybody in cable news is doing.
A media analyst I just watched said that back in the old days, say the 70s, 80s, 70% of Americans trusted the mainstream media. That's down to 30%. But what they do trust are individuals. But there are 900 individuals that round out what they're interested in. And even with Tucker Carlson, he only pulled in about 4% of that number. It's such a diversified thing. Our personality's the way to go, and forget about the network.
Well, character is the way to go.
Character.
If you're somebody who's honestly trying to get it right, even if somebody disagrees with you or whatever, they're still going to find you interesting because they know that you're trying to get at the truth. So, Tucker Carlson was as popular as he was because he was willing to go against mainstream media opinion with a lot of his shows. So he at least simulated a search for truth, and that made him very popular. So it won't really matter so much where you are. The mainstream media could put on popular shows by having guys like Tucker Carlson go out there and badmouth Big Pharma and the military-industrial complex, but they can't do that because those big advertisers pay the bills. So it's kind of a dilemma for the mainstream because you can't have high character and satisfy your advertisers at the same time. Whereas in alt media, it's easy to do. I mean, you just put on your show, you say what you think, and then if it appeals to people, they come. And so you're seeing Matt Taibbi, for instance, have a massive Substack audience, and Glenn Greenwald is huge on Rumble. And Spotify paid $100 million for Joe Rogan's library. So there is an infinite number of opportunities like that out there where there's no dependence on, these criminal organization advertisers. And so I think that it is going to be personality-based, but it's going to be character-based as much as personality-based. And that's a much easier thing to set up in alt media than in the mainstream.
U.S. politics even more unsettled than usual. Robert F. Kennedy Jr. is running against Joe Biden and has pretty good initial poll numbers. How will the Democrats react?
They're petrified. I don't know if you saw this, but they've decided not to have debates in the primary, even though there are people running against Joe Biden. And the mainstream media is just ignoring them. You never see Robert F. Kennedy's name mentioned on CNN, for instance, because there's just this blackout in the mainstream media that he made such a big name for himself, first as an environmental lawyer, then as an anti-vax crusader, that he's got huge name recognition, and a large part of the population see him as being the guy who's right, and the public health establishment as being wrong on a lot of these issues. And he's very articulate with a good grasp of facts and figures and data. So him debating Biden would be a slaughter. It would just be so embarrassing and so debilitating for the mainstream Democrats that they want to try to avoid that at all costs. So they're going to pull out dirt on Kennedy and dump it to the extent that they can find it, and who knows what else they'll do. They're capable of a lot of bad things. And I think they're in a position now where their backs are against the wall, and they're going to lash out in ways that might shock a lot of people.
Does the Trump indictment guarantee him the nomination?
Yeah, it kind of does. It's like the Democrats are actively trying to get Trump reelected because, just leaving him alone, he kind of he steps all over his own message a lot of the time. But if you preempt his personality by picking on him for things that aren't real, like that Trump-Russia collusion thing was totally made up by the Clinton campaign. The Ukraine gate thing was absolutely nothing at all, and they flat out impeached him in Congress over that. So those things make him more popular with the base. And Ron DeSantis was an actual threat to Trump a month ago, but now probably not much anymore because everybody in the Republican base is so mad about this indictment over something that, the Kennedys and the Clintons have been doing forever, much worse, things than what Trump is accused of. That I think Trump gets a sympathy vote, which is amazing when you think about it. But I think if the election was held today, if the primary was held today, Trump would win the nomination with 60 or 70% of the vote. And I don't see a whole lot changing in the short run since the indictment apparently is going to take a long time to turn into an actual court case. With the Democrats thinking timing it close to the election is actually good for them, but they're very wrong. And they're making an incredible political blunder here.
Did Ron DeSantis make a mistake by taking on one of the biggest corporations in America, Disney?
No, that was great for him. Again, we're talking about the Republican base here, and Disney is now seen as the face of corporate wokeism in the United States. So they're a really easy target for Florida, and in particular for the governor. So now this is a gift from political heaven for him. And he will continue to find things. DeSantis is really good at turning issues into legislation. So he will continue to look around and see what's popular with the base and create public policy around that. So he'll be an incredibly popular governor. And he would have made a great presidential candidate if the Democrats didn't indict Trump. So DeSantis will probably, I'd be surprised really if he even runs. And if he does run, it might be that he's running for vice president, wanting to be on Trump's ticket. I think the best way for him to do that would be to pull out now, throw his support to Trump, and in return for a guarantee of being the VP candidate. But we'll see. I don't know.
Would it be, I don't know, from looking from Canada, it seems like we're just going to see a repeat again, Trump versus Biden in another massive showdown, and will the same claims about election fraud and so on be bandied about?
It could just be that we got the same thing over again with the guys doing it being 40 years older. The only thing worse than a Trump-Biden rematch would be a Trump-Clinton rematch. Okay, we really need somebody who's not 80 years old who's running for president here. Doesn't look like we'll get it. What's going to happen is going to happen. I think it's going to be ugly and embarrassing. But it looks like we are kind of baking that rematch into the cake now. So short of one of those guys keeling over, which, okay, let's give that a 40% chance that one of them keels over. So we'll call it a 60% chance that we've got a rematch going forward. And I don't know, which of those things I would prefer to see.
Does it really matter then, given the age of the likely candidates running for president, will voters be looking at who the vice president is maybe more than usual?
Maybe so. I mean, when you've got an 82-year-old president, you're basically voting for the next president when you pick your VP, right? So I think that there's that's another kind of embarrassing thing. Let's not go there. I don't want to get so personal, as personal as I would have to for this part of it. But let's just say that prospect is not one that most Americans are looking forward to either.
Getting back to the economy again, is there any one thing or things that you're looking at that'll tell us what the direction of the U.S. economy will go in over the next year?
Well, yeah, what's the money supply? M2 is shrinking. And I don't think there's anything else you can do if M2 continues to shrink to change the course of the economy, because you cannot taper a Ponzi scheme. You can't turn off the spigot in a system that's over leveraged and hope the system rights itself and grows organically and avoids giant crises. There's just no way to do it. So, go to the St. Louis Fed website and pull up their data on the M2 money supply periodically and take a look at it. If it's still shrinking, then we're heading in a really negative, potentially destabilizing direction. And only when M2 spikes would there be any chance of avoiding a deflationary crash. That might take us back into an inflationary cycle, but the deflationary thing can only be countered with dramatically easy money, and we're not doing that.
John, thank you so much for being on This Week in Money.
Sure thing, Jim. Talk to you soon.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. You can find him on Substack at Rubino.Substack.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBeth.McLeodPartners.com. Welcome back to This Week in Money.
It's always an honor to be on your show.
Hilliard, what do you think the real rate of inflation is in Canada?
Well, that's a great question. It's sort of hit the peak of 7% annually, roughly in Canada, about 8% in the U.S., 10% in England, and it's been drifting lower. The latest number, I think, was in the high 4.9 or 5% or something like that. And but the biggest component of it, so the big headline is always food and energy, and then what they do is they take those two out and call it core inflation, because food and energy are so volatile, according to the people that do it. And so if you look at core inflation, 40% of that number is shelter, which is housing. And that includes rent and also inflation for people that own houses. So if it was properly calculated over the last 20 years, inflation would have been 7% at least, because that was how fast house prices were going up on average every year for the last 2 decades, 7% annually, or a fourfold increase in 20 years. So obviously, they found a way to make inflation look lower by not counting house price gains into the inflation number. So the real number would have been well above 10% if house price gains were included. But now house prices are starting to come down. So inflation has been understated for many years. Should have been quite a bit higher when it was down at 1 or 2%. and house prices were going up by 7%. But now that tide has turned and house prices are coming down, then inflation may be overstated. So that now that if they're saying inflation is 4 or 5%, if you actually calculated the drop in house prices, which in some parts of Toronto suburbs has gone down 30% year over year, inflation would come down quite quickly. But that's not how they calculate it. And you and I have talked before about the actual methods of calculation, but it's a very complicated formula. And people can, if they follow me on Twitter or if they look up my weekend notes, I've explained it on there several times. But what they really do is they take shelter as a combination of the rent, the cost of mortgage. They take a monthly payment method rather than the overall house prices, and they calculate it that way. So it's the goal was to make inflation look lower when house prices were going up fast, and that meant that they didn't have to raise interest rates to try and rein in the gains in house prices when they were going up so fast. So it's changed now, and inflation will come down. But I think inflation is not going to come down as fast as people are hoping for or planning for, because that shelter component and the way it's calculated will mean that inflation stays sticky, is the word they use now.
Do you think interest rates could be heading higher this year?
Well, it's hard to imagine it, but the latest number, as we're speaking today on Thursday, the GDP number in the U.S. came in at a very low rate of 1.1%. But they've got so many inflation measures, but the one that they call personal consumption expenditure, which is what they use for calculating the GDP, came in higher than they thought it should. So they'll probably raise interest rates again at the Federal Reserve in the U.S. and Canada Canada's been trying to diverge. The Bank of Canada's been trying to go a different direction from the Federal Reserve, but I think eventually they'll have to succumb to it. But I think that would be a surprise if inflation stayed strong. Interest rates would have to go higher. They'll go higher on their own, and then the central banks will confirm it by raising the central bank rate as well, until it's clear that we have a severe recession. And that may happen in the second half of this year, and then rates would start to come back down again.
Is the money supply in Canada constricting, and are the banks cutting back on loans? So
what we talked about before, and it's really good for people to know, is that loans create deposits, right? So when new loans are made, when you sign that form to get a new mortgage, that money is created out of thin air. As soon as you sign the document, they put the money into your account, then they use that to buy the house. And it doesn't come from somebody else's bank account in a deposit in the bank. It's brand new money. So the money supply grows, the house prices go up, the economy continues to do well. And then what happens if people stop taking out new loans? Well, then fewer deposits are created and the money supply starts to shrink. So the latest numbers are showing that for the first time, and we're talking about long time, like 40 or 50 years, the money supply has actually started to shrink in the U.S. and in Canada. And that is probably because we don't know yet. It's brand new. It's basically only the last month or two. And the money supply number they use is M2, which is, there's several there's M3, M1, but M2 is the most popular. If that's caused by people taking out fewer loans or smaller loans, or starting to repay their loans rather than take out new loans, then that is a very serious thing. That has only happened maybe 2 or 3 times in the last 100 years. And one of them, when it happened, was at the end of the 1920s, when people had been borrowing very recklessly, and then they got to a level of debt that they just couldn't support anymore, and they started to cut back on the new loans, and eventually they started to default on the loans as well. And that's where you get that Minsky moment, and you get a credit crunch resulting from the shrinking of the money supply and the lack of new loans. So I'm not saying that that's what's going to happen, but it's certainly looking like it's a possibility.
If credit dries up, what happens to the price of homes?
They have to go down. I mean, it's ridiculous. You think about. So I was just thinking about this today, and I thought, the people under CMHC, you can put down 5% as the minimum you're required to put down. And so on $1 million home, which doesn't get you much in Vancouver or Toronto, the young couple come in with $50,000. Well, the stupid thing about that is that they've increased and the other piece of that is the only way they'll give you $950,000 on $1 million home is if it's insured, usually through CMHC or one of the two private sector mortgage insurance companies. But they charge an insurance fee. In Canada, it's charged all up front. In the U.S., they have a similar program, but it's a monthly charge. But in Canada, we pay it all up front. So of that $50,000, something like $30,000 or $40,000 goes to pay the insurance fee, which covers it for the full 25 years of whatever the term of the loan is. So when you think about that young couple, after they pay the insurance fee, they've got $10,000 or $20,000 down, 1 or 2% on $1 million house, and that's just crazy. Like it's just, I mean, talk about subprime mortgages, but we don't call them subprime because the mortgage insurance is on the house, and the mortgage insurance isn't for the home buyer; it's for the lender. In most of the cases, about 2/3 to 3/4 of the time, it's a bank that is the lender. So the new home buyer pays the insurance fee. So the bank doesn't have to pay the insurance fee, but the bank gets all the benefit of having that loan insured. So if credit conditions tighten, or if people finally wake up and say it's insane to have people, basically having zero money into a $1 million home, then house prices have to come down. There's no way around it. Without that fresh money coming in, the number of people that can buy houses with CAD is tiny, 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 and so you need that new fresh money coming in, which is created at the banks with the new mortgage when the new mortgage is put. And if that dries up or even it slows down a little bit, then house prices have to come down because there's always some people who have to sell. Often it starts with new home builders who have got progressively aggressive over the years, building more and more new homes, and if they have to pay the builders and they have to pay all the people that have worked on the construction and everything. And if they can't sell those homes, they have to cut the prices aggressively in order to pay off their debts. And sometimes they go bankrupt. But they go bankrupt, and the receiver is going to just take all those new homes and just dump them on the market. So it'll force prices down. I mean, if you get a brand new home for less than an old, tired home in the middle of the city, a lot of young people would just go for the brand new home on the outskirts. So yeah, prices will come down.
The latest federal budget in Canada has put pressure on mortgage lenders to extend amortizations for people running into financial problems. Would Canada be welcoming 100-year mortgages like the Hong Kong model, and could this cause banks to constrict mortgage lending?
Well, it's pretty crazy. I mean, the banks, in a way, they don't care as long as they get paid the interest on the loan, right? So, and it's a phenomenal thing that just in the last few months, it's gone from zero of the loans were in interest-only status up to something like 25 or 30%, depending on the bank. And so obviously these people were in danger of defaulting, and the banks went ahead and said, okay, well, we'll just keep your payments the same and extend the term of the loan. And in some cases, the payments are so small that they don't even cover all the interest on the loan, which basically means the term is infinity because your loan keeps getting bigger every time you make a payment. So the regulators kind of leave it up to the banks. I've been on this topic for 8 years now with the first edition, the second edition, and I keep getting surprised because initially I thought there was rules that the banks had to follow when it comes to mortgages and stuff like that. But it turns out they're mostly just suggestions, and the banks can basically do whatever they want. Or if there are rules, the banks obviously go to the government and the regulator and say, well, if you hold us to this rule, you know what that's going to do to the housing market, and you don't want a big crash in the housing market. And the government and the regulators say, oh, no, we don't want that. So then say, well, if you could just tweak this rule a little bit, that'll allow us to, extend these terms on these mortgages, and everybody will be able to stay in their homes, and it'll all be great. So you can call it kicking the can down the road or whatever you want, but it's been going on for at least 8 years and probably longer. And we just keep piling up more and more debt and pushing off the day when we have to deal with it into some date into the future.
Japan has just introduced 100-year mortgages, and now they're also in Europe. They're everywhere.
Yeah, it's interesting, that Japan is, in the second edition, I have a whole chapter on Japan because Japan is interesting. The house prices peaked in 1989, and they didn't bottom for like 30 years. So the Japanese house prices, and of course, Japan is different from Canada and the U.S. and other places because generally in Japan, people don't tend to buy and sell homes. A lot of times houses stay in a family for multiple generations. So it's kind of hard to get an actual price index of housing in Japan. So what people tend to use is the land price in Tokyo or something as a proxy. So the land price in Tokyo peaked in 1989 and it kept coming down and down and down. And it bottomed out somewhere in the early 2000s or something, many, many years later, and it hasn't really recovered. So, it's housing is in North America anyway, not as much in Japan, but in North America, housing is a key factor in sort of trying to manipulate the economy to get a jump start after a recession. They cut the interest rates, they cut the mortgage rates, and try and get people to jump into homes and push the economy higher and higher. And but when it stops working, it's a big problem because it's the biggest monthly payment for everybody, pretty much. All the young people, at least anyway. And so if they need to go to 100-year mortgages, I guess that's what they have to do. But you're just creating a whole generation of debt slaves is what you're doing. And it's so unfortunate because it's not productive capital that we're putting our money into when we do that. We're not creating new electrical grids to get the power supply expanded so we can add all the new electric cars that are coming. We're not doing anything of any usefulness. We're just having people go into debt to pay way too much for properties that basically are going to depreciate. The building part of it anyway are going to depreciate over the next 30, 40 years. So it's a really but eventually people will get tired of it and they'll start moving on to more productive things. But the faster it happens, the better, I think.
Are extended amortization mortgages, especially on investment properties, basically just subprime loans?
Yeah, they're all. I mean, I guess when you extend the amortization, you're just admitting that it's subprime. And when I started this, one of the very first interviews I gave, I remember saying something about subprime mortgages in Canada. Now, I really got a lot of pushback on that from a lot of media people and a lot of other people on Twitter and that, because they say there are no subprime mortgages in Canada. And that's just not true. What we have is we've got all kinds of subprime mortgages, but we don't call them subprime because they're insured by these mortgage insurance companies, which other countries don't have, at least not to the extent that we have. So that's one category of subprime. But when you start having to any mortgage, you have to extend the amortization on because people can't afford the higher payments when interest rates goes up. By definition, that's subprime. Obviously, they're unable to meet the payments. And in Minsky finance terms, you're into the Ponzi finance part of the cycle. The first part is investment finance. The second part is speculative finance, and the third part is Ponzi finance. Ponzi finance is when you can't repay the loan and you can't even pay the interest on the loan. And that's what you get into when you start extending the amortization. But those investment people, 8 years ago when I started, they were losing money every month they'd buy a condo and they'd lose a few $100s every month and they have it rented out as an investment. It can't be an investment if you're losing money every month, but they called it an investment. And I asked them, why would they do that? Like, why are you doing this? Why didn't you just sell the condo? They said, well, no, I'll make it up when I sell the condo, I'll make up the difference. And, cause I'll sell it for a much higher profit than I could sell it for today. And that was, there's people that have been losing money every month for 5, 8 years, maybe longer, renting out these properties. And they're losing more than just a couple hundred a month now that interest rates have gone up. They're losing thousands of dollars a month. So it'll come to a head. And, that's why you're seeing amortizations to infinity on these terms on these mortgages because people can't afford to lose money like that.
Currently, how many times income is the price of real estate? And when real estate bottoms, how many times income should it be?
So when I first started doing the research in 2014, I learned that when you take the household income and look at the price of the home, up until 2000, so this whole thing started in 2000, and believe it or not, it's a fairly recent phenomenon. It's only 23 years old. The most of the cycle, the house prices would cycle up and down, but not by very much. And the maximum was generally 3 to 3.5 times. So you had $100,000 family income, say 2 teachers or something back in 2000, you could afford a $300,000 house. That was the way it went. And so fast forward to 2015, it was up to 4.5, 5 times in Alberta, but it was much higher than that in Vancouver. It was up around 9 or 10 times in Vancouver because, believe it or not, incomes are quite a bit lower in Vancouver because there's lots of retired people and lots of non-permanent residents and visitors in Vancouver that don't report much income in Canada. So there was a much higher multiple in Vancouver. And then in Toronto, it was higher. It was 6 or 7 times, and now it's crept up to 8 or 9 times. So for it to get back into the sensible zone, it would have to go back down to 3 times again. So that would be in Vancouver and Toronto probably a 65% drop in house prices. In Alberta, because incomes are quite a bit higher in Alberta, Alberta's only at 4.5, 5 times. So it would only be a modest drop in house prices, maybe of 20 or 25% to get back to that 3-time number. So that's the healthy numbers, 3. And in some parts of Canada, we're at more like 9 or 10, which is very unhealthy.
Last year, Canada gained over 1 million people, most of them immigrants. The push is still on to migrate more people to Canada. Do these people have the money to purchase homes and keep the prices of homes high?
Yeah, the myth is that they show up and then they've got all this money they bring with them. They buy a house and can they qualify for a loan? That's the other thing. You know, I think most people, you need a bit of a track record of earning money before you can qualify for a loan. So you know, and the thing is, I think we'll find out that those numbers are exaggerated, although it's possible they're for real. The census was taken in 2021, so we're now talking 2023. They still don't have the population numbers out for the May 2021 census. So these numbers are all estimates. They're not. There's nothing accurate about them. They basically compile them in some way with surveys and stuff. But it's very difficult to keep track of how many people there are in the country without a census. So in September of 2023, so basically 4 months or 5 months from now, we will get the real numbers and we'll find out. And the other thing to remember too is those numbers are inflated by what they call non-permanent residences, NPR. And those people might be here on a student visa or on a 1-year work visa or a 2-year work visa. There's all different categories. So some of them are not going to stay. Some of them will go back. Some of them, the visa won't be renewed. Some of them never intended to stay. They're just basically here on tourist visas. You meet them on the ski hills. They come for a year of skiing at Whistler or Lake Louise or something. So, but the people that stay, and then of course there's also people that are refugees, and that's become a bigger and bigger percentage of the total. So there's many, many different categories, and technically they're not immigrants until they achieve some kind of permanent status, is my understanding. So we'll see. We'll see how many people actually stay. We'll see if those numbers are exaggerated or not. Once they do the baseline numbers from 2021, we'll have a better idea. We still won't know for sure, but and then we'll find out. If they don't have jobs, they won't stay. If they do find jobs, they probably will stay. I mean, obviously they left wherever they were for a reason, and if they can find a good job and buy a house and settle down, they'll probably stay. But if house prices are too expensive and they can't find a good job, why would they stay? You know, that's the difficulty with letting so many people in. But we do have lots of room for new people. There's 83 million people in Germany, and Germany's not particularly densely populated, and all of Germany would fit inside the province of Alberta with lots of room to spare. So there's room for lots of people in Canada. We got lots of empty spaces. Now, some of it is cold, and there's some mosquitoes and stuff, but we've got space.
And Germany has smog. Germany has closed down the last of their atomic reactors, and they're opening up more coal mines. That's really going to help the climate changers.
Yeah, it's a crazy thing happening over there. You know, you drive through the countryside in Germany. This was quite a few years ago. I went by. There's still lots of farmland and animals, and then there's all these solar panels and wind turbines there. So they've been working on this conversion to renewable energy for quite a long time. And the green movement in Germany, I was surprised to learn this. It goes back to the 70s, and it was entirely based on anti-nuclear sentiment. There was nothing about climate change and fossil fuels and all that. It was entirely, the origins of the movement were against nuclear plants. And I guess that element is still very strong in Germany and some other countries. So France, on the other hand, was getting some really high percentage of their energy from nuclear plants. They have a big company called EDF that makes them, but they're running into troubles with some of those plants now too. So my personal view is that solar and wind are going to surprise people with the ability to cover a lot of this stuff, but that's a minority opinion right now. We'll see what happens.
What's happening with HELOCs, home equity loans, as interest rates rise?
So a lot of HELOCs they're based on prime rate. So the interest rate on HELOC, I have a HELOC and I was just doing my income tax, then it's for investment purposes, so I had to calculate the interest so I could deduct it. And it's gone up a lot. It's like, I think it's up 40%, the total interest cost year over year on this HELOC loan I have. But it's interest only. I don't have to amortize the loan. I just pay the interest each month. On a lot of the HELOCs are interest only. So if they're amortized, if they require them to be amortized, then they become like a mortgage, right? So most people would convert to a mortgage because the interest rate's lower, I think a little bit lower on the mortgage. So, but I don't think HELOCs, a lot of people are taking out HELOCs, believe it or not, to use as a down payment on, to get another property, a second or a third property. So I suspect that because of the interest cost, it's gonna die out pretty quickly. This change from 1.5% interest rates to 5.5% interest rates is just shifting the ground underneath us, and it's a major turn in a new direction, and we're going to see a lot of changes. And you're seeing in the U.S. with all these regional banks that are getting into trouble and stuff. It's rippling through the system, and it's causing real problems. And it basically goes back to when interest rates were so low, people borrowed way too much money. And my thing is, where were the regulators? Why didn't the regulators say, well, this is crazy. People are borrowing 7 times family income when they should only be borrowing 3 times family income. And yeah, they can make the payments when interest rates are 1.5%, but they have no way of making the payments when interest rates are 5.5%. So somehow the government, the banks, the regulators, everybody just kind of went, or they weren't paying attention, and they weren't minding the store, and now here we are. And I don't know, they can do all these gimmicks like extending amortization, but the reality is people have way too much debt.
Well, when stress tests first came out for potential home buyers, people made fun of them, saying there was no way interest rates could rise that high. Well, now we've surpassed those limits by quite a bit. Were those stress tests a good idea?
Well, they didn't work, obviously. So I think it would warrant an investigation. If somebody could do one to say, well, how did people circumvent the stress test? So, because when interest rates were, say, the posted rate was 3 or 4%, but everybody was getting on a variable rate, they were getting 1.5 or 2. The stress test was 5%. So now variable rates have gone from 1.5 or 2 up to 5, 5.5. And all of a sudden we find out that those stress tests, which people somehow were able to pass in the beginning, they can't make those payments because that's why we're having to see extended amortizations. So basically, the extended amortizations are an admission that the stress test wasn't stressful enough. Either it wasn't stressful enough, or there was a way to circumvent it. And I don't know the answer on that one. I don't know what happened. What really happened with the stress tests? Why didn't they work? But obviously they didn't work because...
Well, I think the thing is the stress test only looked at your ability to pay the mortgage under your current circumstances. It didn't take into account 8 or 9 or 12% inflation because the cost of everything else for living, food especially, went up.
Yeah, those people...
Yeah.
Yeah, and that's the thing. They allowed people... Maybe the problem with the stress test was they allowed people to... some ridiculously high number, like 45 or 50% of their income could go towards the mortgage payment. And it turns out that's way too high because the cost of food and the cost of, buying shoes for the kids and all that stuff has gone way up. The cost of putting the gasoline in the car has gone way up. And, so they don't have that money anymore. So that's exactly right. The stress test was flawed. And maybe all those people did meet the stress test. It just wasn't, the stress test wasn't severe enough to be of any use.
Is Vancouver likely the or close to the biggest housing bubble in the world?
It's very close. It's that I haven't looked at it for a while now, but back the last time, a couple of times I looked at it, there was in the world there was Hong Kong, Sydney, Australia, Vancouver were right at the very top. And Hong Kong's kind of an unusual situation because of the relationship with mainland China and all that. So really, it's Sydney and Vancouver. I would say were the two big ones. And Toronto usually came in, and if you looked at the top 10 places in the world, Toronto would usually come in at 5th or 6th or something like that. But Vancouver and Sydney would be in the top 3 consistently. So. Vancouver is odd too, though, because you've got a lot of people with lots of money, but they don't have much income, and so they at least they don't report it in Canada. So so that makes the multiple, which is what those things are based on, makes the multiple look unusually high in Vancouver because of the lack of income. So you got people there that are wealthy that aren't working, aren't reporting any income in Canada. And they're living in $5 million homes in West Van. So how do you figure that, right? So it's it may be a little bit exaggerated, but for sure it's a huge bubble. And part of it too is where do people want to live? Like I know that Seattle was not high on the list of destinations for Asian investors coming into North America. Vancouver was always LA and San Francisco on the West Coast, and then Seattle somehow stuck into 3rd spot, and Vancouver got bumped down to 4th or 5th spot. So things change, and that's another factor where a bubble can burst. When money doesn't matter, it might just be, where do you want to live kind of thing, popularity. It seems to me, though, for people, if you grow up in the prairies, Seattle or Vancouver, just it's very difficult to get used to the rain in the winter anyway. So I don't know. Maybe people just buy homes there, but they don't actually stay there in the winter. They go someplace else.
A lot of satellite kids, you see a surprising number of Lamborghinis with new driver stickers on them.
Yeah, new drivers. Yeah, well, they should put them in Teslas. It'd be safer.
They're on Teslas too. Vancouver is the Tesla capital of North America, more here per capita than anywhere else. Is the spring real estate market likely a dead cat bounce?
I think it is. I see lots of things on Twitter from realtors saying, "Oh, we're getting a real rebound in prices and a whole bunch of new interest in properties." And I don't know. I just somehow I'm skeptical. I see in Edmonton, it's not a good judgment. Edmonton's not a good sample, but the listings just keep piling up. And in the higher end, anyway, older neighborhood where we live, there are now something like 5 or 6 homes for sale in the immediate area. And the other thing that's really interesting, and this is relatively new, is these infill homes, the speculators, the infill speculators have gotten really aggressive the last couple of years, and they've torn down old homes and built brand new homes, either skinnies or full-sized homes, and they're all for sale now, and they're not selling. And I'm just looking at it thinking, wow, how can these people keep building these places and they have them not sell? But that's what happened. It's almost like the timing was really bad because they all sort of appeared in the spring. And of course, they're brand new, so they've got an appeal. Brand new is always preferable for most people to buy rather than an old fixer-upper. So, but they're not selling, and it's because they're too expensive, right? The cost of land plus the cost of construction went way up the last couple of years since COVID. Means that they have to ask like quite a large amount of money for $1.5 million for a fairly modest home. It's a nice location, it's central, but they're just not selling. So I don't know. I think the realtors, I think they're trying to. How can I put this? Everybody has to eat, right? So it's like they're trying to generate some FOMO and some activity and some interest. And but when the people, I'm sure people are interested. Certainly it's probably been like a lot of things. There's been a couple of years because of COVID where people haven't been able to get out and look around. But they can make offers, but when they go to get the financing, if the financing falls through, then that will be the test. So we'll see in May and June if these deals that were done in March were able to be financed or whether the financing fell through.
Is the continued push to work from home causing disruptions in the housing market?
Well, it's certainly, I think it's permanent, and I don't know that it's affecting the housing market that much, but it sure is affecting the office market. You and I generally over the last few years have talked about residential properties, but commercial properties, that's the next big bubble to burst. And they're trying really hard in Toronto and Calgary and Vancouver, and especially in the big U.S. cities, to pressure people to come back to the offices. And it is nice. Like, I work from home. I went into the office today for some meetings. It was very nice to see everybody. It's not particularly productive compared to working from home. In my case, working from home was way more productive. But not everybody. If you have young children in the home, then you can't really hard to be productive working from home. But no, the office towers, that is, and even before COVID, that was with email and all the different means of communication. I think the office towers were already starting to be in trouble before COVID, and now people have found that they can work from home with computers and everything. They work from anywhere. The refilling those office towers is going to be very difficult, possible probably. And I saw a thing, I've been asked quite a few times about converting office towers to residential, and I looked into it briefly and discovered and was told that because of the way that office towers are constructed, it's not very easy to convert. It's expensive to convert. And I just saw a report a couple of weeks ago from one of the big U.S. Investors in real estate saying that, the proper thing to do is just to demolish those high-rise office towers and start over, because they can't really be converted economically. And there's just way too many. There's way too big a surplus. But there's also retail. A lot of times there's retail in the first and second level that they're having trouble filling as well. So if the tower is half empty, then the people that have the restaurants and the shoe repair and the dry cleaning and all that, those people can't make a living either, right? So it's maybe the guy is right. Maybe demolish those buildings and start over, redo the downtowns of all the major cities in North America. It'd be a good project and would create a lot of work for people. And I don't know, but how do you? Even with bankruptcy, you're going to have trouble convincing people to demolish a perfectly good building that's $100 million has been put into. It would be difficult to make that decision.
Now, I saw a story where somebody has developed modules that you could just park inside those office spaces. I guess it'd be like your own camper trailer or whatever, but modules that could fill that office space without a lot of renovation being needed.
Yeah, well, that's the problem, is the way the walls work and all that. That would fix that problem. The module would bring its own walls with it, right?
Yeah,
but
exactly.
But you still got the problem of plumbing, which is, you got to have plumbing for the kitchen, and you got to have plumbing for the toilet, right? So then the and the shower. So the problem with those buildings is they're not built for all of the washrooms. Well, first of all, they're not built for kitchens or showers, and they do. Some offices have, but generally you'd have to have a whole different layout of the plumbing and the thing, and the modules wouldn't fix that. So yeah, I don't know. I don't really think that. And also the whole idea of everybody going downtown in rush hour and then coming home in rush hour is really flawed to start with, right? It's like, why spend 2 hours in Toronto it's more like 3 hours a day fighting this immense traffic jam, whether you're on the GO train or whether you're driving on the freeway. It's not a very productive use of your time.
When the housing bubble really bursts, are there strategies to reduce risk if people want to catch a falling knife by aiming to pick the bottom?
Well, I remind people that we talked a minute ago about Japan. That was like a 30-year downtrend. That seems like a really long time. The one that was quick was the U.S. The market peaked in 2006, and it bottomed in 2010, and it was sort of by 2012. So it's somewhere between 4 and 6 years from the start of the downturn. So if we take that the downturn in housing in Canada started a year ago, because right now we're looking at prices that are 16 to 20% lower, depending on which house price index you use. Then it started a year ago. So we've only got 3 more years to go. So it's like, I wouldn't get too excited about catching a falling knife, until at least another year or two goes by. And of course, the recession, which always is whenever you get a housing bubble bursting, you get a recession because housing is such an important component of the economy. And, the recession could speed that up, and we could, start seeing bargains. But the problem is, it's not like the stock market. The stock market goes down a lot faster because people dump their stocks quite easily. On housing, people are emotionally attached to their house, and they don't want to sell a loss, and they stick it out way too long. And even in the U.S., where that was a really good experiment to observe. About half the states in the U.S., you can just walk away from your home. Once your equity is gone, you can just walk away from your home, and they can't chase you for the deficit, unlike in Canada, where almost always they can chase you for the loss after they sell in foreclosure. But in the U.S., you can just walk away. And only a tiny fraction of the people that had the opportunity to walk away with no penalty when their house was, upside down, as they call it, or underwater on the mortgage, only a tiny fraction of them walked away. The rest of them just kept making the payments, even though that makes no sense whatsoever. So because of that, you don't get a fast downturn sell-off the way you do in the stock market, where, like stocks like for instance, a good example is Amazon. It was $64 in 2000, and it bottomed at $6 in 2002. So 90% drop in 2 years. And you don't get that in housing because people hang on even when it's economically or financially not advantageous. They have emotional reasons for hanging on.
Could we see banks or credit unions go under in Canada?
Well, credit unions generally are all guaranteed by the province. So the government of Alberta guarantees all the credit unions in Alberta. The government of British Columbia, the same, and Ontario is the same. So it's hard for the credit unions to go under. They can certainly lose a lot of money because they were big lenders in the housing market like everybody else. The banks is a little bit different. The banks generally are created by the government. They're special charter. That's why they're called charter banks. And they will not be allowed to go under. But certainly the equity shareholders in the banks can get hurt. And in 2009, generally the banks in Canada went down, not as much as the U.S. The banks went down. The best way to think about it is book value. So earnings don't really, not a good parameter for banks because for various reasons. But book value is good. So the Canadian banks were trading at 2 times book value. They've come down to about 1.7 times book value. The U.S. banks in 2009, when they had some of them went away altogether, but the ones that survived, they never were trading at 2 times book. They're sort of trading at 1.5 times book value on average, a little bit lower than Canadian banks are now, and they went down to half of book value. So that was pretty big loss, and about 2/3 of the equity was lost. And then it rebounded. And now the American banks, having bottomed at around half of book value, are back at 1 to 1.5 times book value. So Canadian banks could go down from 1.75 times book value down to 0.75 book value or something like that, and maybe a 50% loss or something like that. But the depositors will be covered, and the bank will survive. They'll struggle, but they'll survive with help from the government. And but the shareholders, a lot of whom think they're pretty immune to any downturn, might be in for a shock. And one of the things that's true in Canada, which is not true in the U.S., is that some of the Canadian banks have consistently paid a dividend since 1834. So it doesn't make any sense for the government to bail out a bank and allow it to keep paying dividends to its shareholders, right? So that would be one of the shocks that might hit Canadian bank shareholders, would be if the government does have to step in and give the bank some help. They didn't require it in 2009, unlike the American banks and the European banks, who the government forced the banks to cancel their dividends temporarily. Because the Canadian banks have this long track record of paying dividends consistently since 1834, or various dates, but all in the 1800s, the government didn't want to force them to cancel their dividends, so they didn't. But in this round, with things going the way they're going, there's a possibility that might happen, and that would be a shock. Because when I talk to people about Canadian banks, they all say, "Oh, I like the dividend. I love the dividend. The dividend's so steady, and I don't worry about the share prices. I love the dividends." So that would be a shock to people. But I'd encourage people to think about possibilities of things being quite surprising in this downturn. And going back to, house prices don't have to go down that much for trouble to start, because there's so much debt in the system, right? And never have we had a downturn before. The 1990s had a downturn where house prices went down 30%, but people had a relatively small amount of debt because interest rates had been 10%, 12%, 15% up until that time. And so nobody could qualify for a large loan when interest rates are that high. But when interest rates have been 1.5%, 2%, 3% for more than 10 years, everybody gets loaded up with too much debt, almost everybody. And so a small downturn in house prices could create big problems for society in general. And so canceling the dividends on Canadian banks would be a pretty small, to the bank shareholders, it'd be a shock, but to the overall system, it would be a fairly small sacrifice to make to try and help get through a crisis that's caused by the housing bubble bursting.
Does Canada need to up the deposit insurance guarantee from $100,000 to $250,000 like it is in the U.S.?
Well, it's interesting. I just had a long conversation with somebody this morning who's got quite a bit of money, and he's concerned about the deposit insurance in Canada, and he's going through all this extra work to divide it up among all these different banks, and it's like a total waste of time, right? And I said, well, why don't you just go and buy government bonds, and then you don't have to worry about the bank, the deposits. But for the little guy, it's I was going up the ski lift a couple of weeks ago, and two older guys beside me, talking about all the strategies they have for spreading their money around different GICs and different credit unions and like organizations I've never heard of. The guy was saying, "Oh yeah, I've got 100,000 there and I got 150." So it's just like, I guess it's something entertaining to do. I don't know if they got nothing better to do with your time, but it seems like such a waste of time because really, in reality, I think the government is going to have to make all deposits. They'll have to extend the guarantee too. But legally, that's not the case. So the easy solution to it is for people that are interested in this and don't want to play that game is just to go and buy the government securities directly. And right now, the good thing about that is that you're yielding 4 or 5%. So you don't have to worry about it. And you probably get as good a rate from government securities or even higher, and not have to worry about all these deposit insurance questions.
Could we be in for the great housing depression?
Well, certainly housing is a factor in depression. I mean, the word depression, what does it really mean? The debt deflation cycle is what you have to worry about. And that's there was an economist named Irving Fisher. He was an early writer about the debt deflation cycle. And of course, that's where you get forced liquidation of assets because the debt is too large and people go bankrupt, and then the receiver takes over, the bankruptcy trustee takes over and sells the assets. And usually they don't care. If your house was worth $1 million and they end up selling it at $300,000, they don't care because they're not getting paid. The loss has already been taken by the lender, and their role is just to liquidate the assets. And that's this great liquidation thing. And it happened in the 1930s. In fact, they tried to do it in Western Canada and in the U.S., in Kansas, and places like that with the farms. And they would have these farm auction things where the bank had taken over the farmland already. They were trying to auction off trying to get the farmer to move off the property. And the farmers would all show up with pitchforks and weapons, and they stopped the liquidator from coming and liquidating the assets off of the farm. So it gets pretty crazy when you got a really severe real estate liquidation going on. And it's not just houses, but it's all kinds of things to do with farms and office buildings and houses. And the thing is, it really requires that there be a real reset on the amount of debt in society before the cycle can start again. And otherwise, you have people like we started out talking about, these people with infinite amortizations on their payments. They're making $2,000 a month payment, and then debt will never be paid off at that rate. So all the money goes to interest payments. So they can never progress. They can never invest the excess money into more productive enterprises. And you can let that happen, but it would be a very long depression would be the word for it, of people just paying interest to the bank, but nothing really happening. And in the Great Depression in the 1930s in the U.S., they did have various strategies to get people out of that slump. And it involved the government putting money into the system, because the government could print new money and put the money into the system and jumpstart the economy that way. And they did eventually do that. And after several years of trying different things, they finally, and then of course the Second World War caused a huge increase in demand for production and got things going even faster. So, but if those two things don't, if the government doesn't put money in, and if you don't have something like a war to get the demand going again, you could be in a slump for a long time while people just make payments to the bank or not make payments to the bank if they can't afford to. That's another possibility too. And the bank just has to sit on a bad loan. Unfortunately, in Japan, that was one of the reasons why they had a 30-year slump, is because they didn't write off the loans. They didn't reset the debts. But people weren't paying back the loans either. So the banks were sitting with all these, they call them zombie banks, because they didn't have any, they couldn't lend any money out because nobody was repaying the old loans, and they were just stuck. And it went on for more than 30 years. So hopefully we'll be smart enough to avoid that if it comes to that.
Could making society beholden to the government lead to the wipeout of the middle class?
Well, I think everything we've been talking about today is going to hurt the middle class. You know, the middle class. So I ran in my research for the book. I ran across the definition of middle class. And I never heard one before, but it was ownership of a home. It was education, which would allow you to get a variety of a number of jobs, and there was a couple other things that were kind of a requirement to be in the middle class, maybe access to healthcare or something like that. But for most people in the middle class, the mortgage and the home and other debts, that sort of thing, is a very big factor. You know, you can never really get in a normal person's work life. You never really get that much extra money to get the mortgage paid off, plus a whole, but many more millions of investments. It just doesn't happen. You got to, help your kids get established, help them get some education and all that. And by the time you're 60 or 65 years old, if you got your mortgage paid off and your kids are all independent, that's a middle class success story. And so, if we have a situation where the housing is in the slump for 20 or 30 years, that's going to really hurt the middle class, and because so much of their wealth is positioned around that. So, I don't think the middle class will be wiped out. But more importantly for the middle class or as important maybe as the housing thing is, what about the type of jobs that people get? Because a lot of the jobs that the middle class normally would have been attracted to in the last 30 or 40 years, was like director of this and general manager of that and all that. A lot of those jobs have disappeared. You got your workers, and then you got your senior executives that are like the capitalists at the top of the system. And that whole middle management segment has been eliminated in a lot of cases. So, it's going to be tough for the middle class. And, it's, no question, it's a lot tougher than it was when I graduated from university in I won't say how many years ago. It was a long time.
Today in Canada, how much net worth do people need to be considered rich?
Well, I think to be rich, you have to have enough income coming from your investments that you don't have to worry about working, right? So if you're, and then so that depends on what your lifestyle is. But let's say you could live on, let's pick a number, $150,000. Let's just say for fun, and let's say you can make 5%. And this was a much tougher if a year or two ago when the number was more like 2 or 3%. But now 5% is possible. So if you've got $3 million in investments saved up outside of your house, not counting your house because the house doesn't produce any income. At 5%, that's $150,000 a year. So I would say that somewhere around 2, 3, 4 million people can be comfortable, and you're not flying in private jets with $150,000 income. Once you pay the taxes on your house and a few other things, you still have to be very careful with your money. But I guess you don't need to go out and get a second or third job.
What are your thoughts on artificial intelligence and how it could affect the workforce, business, the economy, and real estate? Well, frankly, everything.
I was listening to a podcast that was talking about artificial intelligence, and Elon Musk has said he's very worried about what artificial intelligence might do. And he proposed a 6-month moratorium, although I don't know what 6 months is going to change. But I guess there's some very big advances coming that Elon Musk would probably know about before we would. But just for fun, I tried it. I said, this is going to sound a little weird maybe, but I plugged in my own name and I said, write an obituary for this person. So just to see what it would come up with, right? And it sounded really good. I mean, they had this glowing obituary for me. But none of it was right. And there's lots of information available about me because of the books and stuff. but none of it was right. It was all made up. It was totally fake, right? That's the scary thing. Like, we get to a point, and it could happen in 6 months, a year, 2 years. It'll be totally impossible, completely impossible, to distinguish what is real and what is fake, because the artificial intelligence is getting so good at making stuff up. And and I've tried other times with other topics where stuff I know something about, I put it in and say, tell me about this and that, and it's actually quite accurate. So sometimes it's accurate, sometimes it's totally fake, and who knows what, how are you going to be able to tell what is real and what is not real? So that's, I think, the frightening thing about it. But if it can be channeled for good, whatever your definition of good is, it could really free people up. I mean, there's an awful lot of work that people used to do about information, where they memorize information and be prepared to regurgitate it and all that sort of stuff. Maybe we don't need to do that anymore. We could put that time and effort into something more productive. So it's possible that it could be a very big new force for evolution, and allow us to get more free time or pursue things that are more, let's say, more entertaining or thoughtful or productive. But on the other hand, it could also be really scary prospects for manipulation of people's lives. You think about the advertising industry, for example. They have something called truth in advertising, but it's not enforced, and so some of these ads are just totally fraudulent, right? They make claims that are not correct, and I don't know if people believe them or if they don't. I mean, if something I know something about, like electric vehicles, sometimes it's completely wrong, and but I'm sure that people don't know that much about electric vehicles yet because they're new, and so they might believe it. But so where do there's no authority that's going to step in and say, okay, that is false, and therefore it can't be allowed. There's no, nobody would want that anyway, probably. So I think it's going to be mixed. It's going to help in some areas. It's going to be very, very dangerous in other areas. But there doesn't seem to be any turning back now. It's here, and it's going. I just hope it doesn't. I keep thinking about the movie. What was the one? Is it Terminator, where the machines decide to eliminate all humans?
Yes, that's right. The Terminators.
Yeah. Like some of this stuff. And Isaac Asimov, who was writing in the 70s and the 60s, he had already foreseen this and said, there has to be 3 rules. And I can't remember I think the first rule was do not do any harm to humans or something. And then there's 2 other rules.
By your own action, not allow a human to be harmed, and then make sure that you're not harmed. Those were the 3 primary robotic rules. I'm an Isaac Asimov fan.
So, well, isn't that great? You remembered that. And so we need some kind of Isaac Asimov rules for artificial intelligence, but I don't know, how do you enforce them? I don't know. So anyways, lots of interesting things happening. And the sooner we get over our obsession with housing, the better, I think.
Robots don't need houses. Is Canada likely in or headed for a recession?
Yeah, we could very well be in a recession now. There's no way to know. I mean, the really confusing thing is employment numbers are good, so ridiculously good. And but Statistics Canada has these crazy seasonal adjustment things. And one theory that I saw, which makes sense to me, is the COVID period in 2020. They had to make some big adjustments to the seasonal adjustment numbers to make any kind of sense of what was happening. And the theory is that they went too far in tweaking the seasonal adjustment factors that are plugged into the raw numbers. And so now we're seeing some ridiculously large gains in employment that actually are not accurate. So, but who knows? I mean, it's just impossible to know. But a recession is probably in it. And when you see, a few minutes ago we talked about M2 declining in the money supply, and when you see that and the number of new loans is shrinking, then that has always been a pretty accurate indicator of a recession. So, and we're due for a recession. I mean, it's been quite a while, 2009. And then in Canada, we had a very mild recession in 2009 compared to the U.S. So that's 14 years. Usually these recessions come along every 4, 5, 6, 7 years. So I'm not counting 2020 because that was like a recession that lasted a couple of months. It's not really a real recession. It was a very odd situation. So, so this recession is going to be more drawn out affair. And if you get a housing bubble bursting and a recession at the same time, then it's going to be something that we haven't seen for probably since the 1980s.
Edmonton has a push on to be divided into 15-minute smart cities. What are your thoughts on living in a 15-minute smart city, and what could it mean for the price of real estate?
Well, I don't understand it. I haven't really looked into it, but the whole idea of and this may not be what they're talking about with 15-minute cities, but the whole idea of having to get in your car every time you even want to go to the corner and get a loaf of bread or something, it's just, I wish that we could find a way. It was all based on the automobile, and our cities grew from the 1960s until now, so 60 years, whatever it is, of growth, all based on automobiles. And then you get these endless kilometers of strip malls with very similar stores, one after another. And it's just unfortunate. And then some of these European cities are converting to streets where there's no cars, and there's shops and restaurants and places to walk. And to me, that would seem to be much nicer. So I don't know if that's what the 15-minute city is about. I don't know, but that might be a good thing. But I don't really know. I have to look into it.
Everywhere you go in Vancouver, there are Teslas. What do you see ahead for the EV revolution and the growth of Tesla?
So there's a really interesting thing happening right now. My weekend note, which comes out on Fridays, people can access it through my Twitter account, HMACBE. I'm going to write about that, and because what Tesla is doing is cutting prices. They've cut the price of their most popular model. It's called the Model Y. It's sort of a large version of their smaller Model 3. They've cut the price to below the average price of a new vehicle in the U.S. So it's around $50,000 the average price, and they now got a Model Y that goes for $47,000. So this is something like the 7th price cut that's been introduced by Tesla. And a lot of people are saying it's because they've got too much inventory, but it's also perhaps because they want to expand their production and try and get more and more people to adopt electric vehicles, which is their mission. So in any case, it's going to be a very interesting. So it's still only in some countries like China, it's 25-30% electric vehicle sales. In Norway, it's even higher than that as a percentage of total. In the U.S., it's still only 4 or 5% of new sales are electric, fully electric vehicles. So there's a long way to go. The number of cars sold in the world every year is 80 million to 100 million, depending on how you define it. And so the electric vehicles are still a tiny fraction of that. But if they're cheaper, they're certainly a lot more fun to drive. They're certainly a lot more economical to operate. So if they're cheaper to buy up front, then that removes really the last barrier to widespread adoption of electric vehicles. And I would think that now one of the things that drove that was the Inflation Reduction Act, which was brought into the U.S. recently. And there's some big incentives for electric vehicles, but they have to be a certain price. And there's a wrinkle people might look into if they're looking into it. And this may only be a U.S. thing where leasing works better than purchasing and borrowing the money to purchase. So, and then of course there's a problem with car sales because most car sales now are financed, and the interest rate on borrowing money to buy a car is much, much higher than it was. So it's making it much harder for people to buy cars. But Tesla at least is the big thing is happening is, and Elon Musk announced that he's willing to take a lower profit margin in order to sell more cars. So that's a pretty big, pretty bold bet, and it's may turn into a real fight between GM, Stellantis, Volkswagen, Ford, and Tesla. And we'll see what happens.
What's the top speed you've had your Tesla Plaid up to, and where did you do it?
I don't think I can answer that question. I know that I thought about going to the racetrack where they've got all the straight line and there's no speed limit, and apparently my car can go a quarter mile in 9.2 or 9.3 seconds, and I think the top speed is 150 miles an hour. I don't know what it would be in 300 kilometers. That seems too high, doesn't it? Anyway, it's pretty phenomenal. But you need to have a roll bar, and I don't think they don't consider the car itself to be adequate for that, which I don't understand. But anyway, you have to have a fire retardant suit, and you have to have a special helmet. Like, your ski helmet isn't good enough. Apparently, you need a special racing helmet for car racing. So if I can borrow all that equipment, I'll go, and then I'll report back to see what the top speed was. But it's one of the things that's pretty neat about this one compared to the previous two I had was the acceleration is phenomenal, up to 100 kilometers an hour. But it apparently, and I haven't done this, but it keeps accelerating all the way up to 200 kilometers an hour at the same, not the same rate, but a similar rate, which wasn't true in the previous two versions that I had. But they're not selling very many of these Plaid Model S Plaids. The sales are way down on them, so I don't know if it's because people don't want to spend the money, or if it's the Model Y is the one that we were talking about a minute ago. Is $47,000 is the really popular one. It's got lots of extra space for the kiddies in the back and stuff like that.
Do you think there's a bright future for electric vehicles? I know there's been pushback, probably because of their high prices.
Yeah, no, I think the adoption is. I think I make a fearless prediction that the adoption rate of electric is going to be much faster than people think, and it's not. It's not because. Although it's true that they are more fun to drive and the acceleration's way better and the cost of maintenance and operation is much lower. But it's going to be because the two things, the cost is way down now, mostly because of these price cuts that are coming in. And then people are intrigued, they see a bunch of Teslas and remember when the iPhone came out and everybody had I had my Nokia whatever, and my Motorola, and I had a BlackBerry, that's right. And I thought, well, the BlackBerry's better, I don't want one of those new iPhones and stuff. And wow, how long did it take? Less than 3 years. And all those other models were basically overtaken by the smartphone, the iPhones primarily. And then everybody else that wanted to survive had to come out with a similar model. And all those other models got left in a disaster. It's the old tipping point thing. It happens faster than you think when it starts to happen.
Hilliard, thank you so much for chatting with us and for being on This Week in Money.
Thanks very much, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. You can find him on Twitter at HMacBE. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.